Thank you very much, Stuart, and thank you to everyone who's still here, particularly those who are still standing at the back, although they've been standing for quite a while. Hopefully this will be worth your time, worth staying for. Over the next 50 minutes or so, I'm going to say something about the outlook for living standards over the next few years, and in particular, what new did we learn yesterday. Before I turn to the future, though, let me kind of just bring you up to date with the picture we have up to at the present, or actually up into the most recent data, which is for 2014-15. So this takes real median income, that's the household income of the person in the middle of the income distribution, and sets it to 100 in real terms, 100 in 2007, and then looks at what's happened in real terms since then through to 2014-15. And you can see that it fell in the household income fell at the median in the aftermath of the financial crisis, and then there's originally a very slow recovery with a slight pickup in the latest year of data, leaving median household income for the population as a whole 2% above where it was pre-crisis. But that picture for the overall population marks very different changes in living standards for different groups. So just to take one example, if we split this line out by age, so when we look at those young adults aged 22 to 30, their incomes were still 7% lower than the pre-crisis levels in 2014-15, largely because they bore the brunt of falls in employment and earnings associated with the Great Recession. If we look at 31 to 59-year-olds, they basically back where they started. Again, big falls in earnings, but not quite those affecting young adults. But the big contrast is between the working age population and pensioners. So if we look at those aged 60 and over, their real incomes were 11% higher in 2014-15 than back in 2007. Now, there's lots you can say about why that happened, but one kind of simple way to try and tell the story is to look at what's happened to key sources of income for these different groups. So here we're going to do exactly the same exercise, but rather than looking at overall household income, just look at the real terms path of earnings, benefits, and the state pension through from 2007-8. So starting with earnings, as Paul said, in some sense this is the defining characteristic of the Great Recession. Unprecedentedly large falls in real earnings, which according to the OBR, even in 2015-16, still left real earnings 7% below pre-crisis levels at the average. Out-of-work benefits, despite freezes actually around where they were pre-crisis in real terms. And then explaining the increase in pensioner incomes is the sharp rise in the basic state pension resulting from the way the triple lock policy has worked over this period. Now, of course, the picture for average earnings isn't representative of what's happened for the lowest earners because of the national minimum wage and now the national living wage. So when we look at that, you can see that although there's still a big real fall, it was protected. These lowest earners were protected relative to the average earner, and that's going to be an important part of the story going forward. So that's something of where we are and how we got there. What can we say about where we're going over the next few years? Well, the big picture is that kind of regardless of how you cut the cake or how you do the analysis, slower future growth has to eventually mean lower future living standards. So just to kind of give a sense of that, we were talking about these revisions to GDP back in the earlier presentations. The OBR forecast for real GDP for national income in 2021 is £30 billion lower than it was back in March. And that's equivalent to national income being to a fall of £1,000 per household. That's how much lower GDP will be in 2021 than expected. Now, it's important to note that when we think about GDP, that includes everything in the economy. It's not a direct measure of the cash in people's pockets, but it is a good indicator in the long run of the resources that as an economy we'll have to spend on supporting our living standards. Now, as was mentioned, the vote to leave the EU was not the only thing that affected the OBR's forecasts between March and November. And in fact, the forecast effect of Brexit, the Brexit vote, on GDP, real GDP in 2020-21 was actually larger than the total forecast revision, so around £50 billion. And if you convert that into kind of household terms, that suggests that the OBR's figures are for real GDP per household to be £1,250 lower in 2021 as a result of the vote to leave the EU. But that's just talking in kind of broad brush terms about national income. What if we try and say what's going to happen to real household incomes, the cash that people have to spend? So there's two main ways the effect is going to pass through. The first is higher prices facing UK consumers. Now that's something that there's been a lot of conversation and discussion about in recent weeks and months, Marmite wars and so on. That's driven by the depreciation in sterling since the vote to leave the EU. But the second one, which has kind of understandably, because it hasn't been as clear, received much less attention, but actually, in terms of thinking about living standards, the OBR's number suggests is about equally important, is lower cash earnings for UK workers. The OBR's revised down its forecast for how fast UK productivity is going to grow, and that's going to feed through to lower cash earnings as well as higher prices. So first, let's say, okay, what can we say about how these kind of changes feed through to exactly the same sources of income that we were looking at a minute ago? So this is just the same graph I was showing you, just on a slightly different scale. So let's start with average earnings. Back in March, that was the OBR's forecast, what was going to happen to the average earnings level, and that's the revision through to November. That's the revision that we found out about yesterday. So two main things to note. One is if you kind of look at that level in 2020-21, that says that average earnings are expected to be about 3.7% lower in real terms than we expected back in March, or than the OBR expected. The second is that, as Paul mentioned, that solid black line, the current forecast, leaves average earnings in real terms below their pre-crisis levels even by the end of the decade. And in some sense, that is the heart of the story and the problem on living standards. It's that stagnation in average pay over a very, very long period of time. Turning to the national minimum wage, or the national living wage, as we look forward to 2020. Back in March, the OBR was forecasting a very sharp increase in that living wage. And because the national living wage is set, the target is for it to be 60% of median earnings in 2020, falls in average earnings now pass through to falls in what we expect the national living wage to be. And that's what we show here, the same, kind of exactly the same downwards revision. Turning to the basic state pension, here was the forecast back in March, and you can see that it looks basically exactly the same as average earnings in terms of growth, and that's not a coincidence. Average earnings was binding in the triple lock in each year, and so the state pension was expected to grow in line with average earnings. As we look at the November forecast, again, the downwards revision looks very similar to that for average earnings. And that's because, despite the falls in average earnings, they're still what is binding in the triple lock. And so although in one sense the state pension is protected against inflation, i.e. it can't ever fall in real terms in a given year, its real terms level in 2020 is now expected to be lower than we thought back in March because real earnings growth is lower. Okay, so that's the kind of broad picture. Oh, sorry, the last one, job seekers allowance. So there's a real fall in the March forecast, and that's because of the freeze to most working age benefits that the government announced back in the July budget. That freeze is now slightly bigger because inflation is slightly higher. But you can see that the difference in that JSA forecast, that's just the price level. Whereas the difference in everything else is the combination of the price level and the fall in productivity. So turning to the price level, what can we say about who pays the price for higher inflation? So the OBR now expects that the prices UK consumers face will be 1.4% higher in 2021 than they expected back in March. And as we've kind of said, that's because the lower value of sterling in their forecasts increases the cost to the UK consumer of buying goods that are imported or use imports in their production, and that's going to pass through into higher prices. Now, actually, recent work that we published a couple of weeks ago in an observation shows that if you just think about the effect of that devaluation on the cost of the basket of goods that different kinds of households buy, the effect's pretty flat, both across the income distribution and across ages. But it's important to remember that different kinds of income respond differently to changes in prices. So to give an example, a public sector worker who's now retired, receiving a CPI index pension, well, they're perfectly protected. That pension is completely protected from the increase in CPI. Whereas earnings, for example, don't have that automatic protection. They don't automatically respond to higher prices, and indeed the OBR don't expect them to on average. Now, when you're thinking about the kind of households' incomes that will rise automatically to offset higher prices, that normally includes both pensioners who have index-linked pensions and low-income working-age households whose benefits are indexed, increased each year in line with inflation. But back in the July budget, the government chose to break that link until April 2020. And so what you have is an interaction between past policy and changes in what we think is going to happen to inflation. So this shows the impact of the benefits freeze given the March forecast for inflation. So again, standard IFS decile chart, we've got the poorest on the left and the richest on the right. And that was, at the time of the March forecast, this policy was expected to reduce the real value of benefits affected by 4%, and that would reduce the incomes of 11 million households by £280 a year on average. But because inflation is now expected to be higher over the next few years, but these benefits are going to be the same in cash terms, those numbers all get bigger when you move forward to the November forecast. So the real effect on these earnings is a 6% fall, and the same 11 million households losing an average of £390 rather than £280 a year. So that's higher inflation. What about lower earnings? Well, the OBR now expects that in cash terms, average earnings will be about 2.5% lower than in 2021 than they expected back in March. And that's basically down to lower productivity. So the OBR thinks that the uncertainty created by the vote to leave the EU will reduce the amount that firms invest over the next few years, and that will feed through into lower productivity for UK workers. And so if you combine that 2.4% reduction in cash average earnings with the 1.4% fall in prices, and then account for rounding error, that turns out to be a 3.7% decline in forecast average real earnings in 2020, as I showed you earlier. Now, what does that mean for the national living wage? Well, the headline is that it's expected to be 27p an hour lower in real terms than was expected back in March when we look out to 2020. But that comes in the context, it's still much, much higher than what we would have expected if there'd just been the national living wage if that policy had never been announced. So as I come to a close, what I want to do is try and draw these different strands of reforms to wage policy, to tax and benefit policy, and effects of the macroeconomic forecasts to see how they all affect an example household. So I'm going to take a lone parent working 16 hours at the national minimum wage and then the national living wage. And the question is, how has their expected net income in 2021, in real terms, changed over time as government policies evolved? So 0 here is their expected net income given macro forecasts and government policy when the Conservative government came into office. So the Conservative government announced a national living wage. That increases the earnings of this lone parent because she's on a minimum wage, and that increases her net income, or the net income of this example lone parent. But at the same time, in the July budget of 2015, there were a number of tax and benefit policy changes, the net effect of which was a very significant fall in her expected income in 2020-21. And that's because we're assuming this lone parent is on universal credit. And so that big fall is the combination of the announcing of the benefit freeze, plus the announcement of the cuts to work allowances, plus the abolition of the family element, which is another bit of universal credit. Then there were some kind of trivial macro revisions between May 2015 and March 2016, and so if you kind of think about where this lone parent was, or this example was, before yesterday's statement, changes since the Conservative government came to office had reduced her expected income in 2021 by about £1,300 a year. So what happened yesterday? Well, as Stuart talked about, there was a small giveaway, the reduction in the taper rate. That boosts this example person's income by about just under £100 a year. But at the same time, that was more than offset by the effects on our incomes from the downwards revision in earnings and also higher prices. So just to say that final effect, the effect of this reduction in cash earnings and the higher prices facing households, that's quite small relative to the big benefit changes back in July for this household, for example. And that's partly because this household is on benefits, when their real earnings fall, they get quite a lot of that back in higher benefit entitlements. And that's important for kind of driving the relative importance of these things. So if you took a much higher earning person, where earnings is more important and benefits mattered less, then it would be the macro forecast that would really show through. So to conclude, living standards over the next few years are expected to be hit by a combination of higher prices and lower earnings relative to what we thought back in March. So just to give an example, that the OBR expects average real earnings to be 3.7% in lower than their March forecast, and indeed that leaves them still below their pre-crisis level. That squeeze on productivity and hence on cash earnings, that will be focused on working households. Pensioners will feel that less. And because some of them have access to index-linked pensions, they'll be more protected from the rise in prices, particularly given the working age benefits freeze. But it's worth remembering that the real increase in the state pension will be lower than previously expected, despite the protection afforded by the triple lock. Thinking about low-income working households, the next few years will see, for some of those, changes in their benefit entitlements and a cut in the average generosity of benefits for that group, coming on top of the effects of lower earnings and higher prices. And for some low-income working families, these will actually matter more than the weaker macroeconomic outlook. Thanks very much. I'll hand back over to Paul for questions.